I want you to imagine this. If you had just invested $10,000 right now and didn't contribute another dollar, in 30 years, that $10,000 would grow to over $100,000. And that, ladies and gentlemen, is the power of compound interest. And over the past couple years, we've experienced one of the most volatile markets in history, from the COVID-19 crash to Trump's tariffs to the massive AI demand surge shaking up the entire tech sector. And if you're new to investing, all of this might feel a little bit shaky, and that's completely normal, which is why I am here to help you. Now, before this video begins, I just want to disclose that I am not a financial advisor, and you should always do your own due diligence when it comes to investing. Investing comes with risk, and I mean everything in life comes with risk. Alright, so now that we got that out of the way, here are the 5 rules of investing you must know as a beginner. Starting with rule number 1, never lose money. This is a famous quote by the greatest investor of all time, Warren Buffett. And while that sounds simple, it's one of the most misunderstood rules in all of investing. Buffett isn't saying your portfolio would never go down. He is simply saying that you should avoid permanent loss, and that starts with controlling your emotions. Don't buy out of greed, and to never sell out of fear. Always be patient, because time is your greatest asset and advantage, not timing. And you only lose when you realize a loss. A temporary drop in price action isn't a loss unless you panic and sell. And to never invest in a company just because a friend, a neighbor, or a YouTuber told you. And always do your own diligence, because you will understand exactly what you're buying into. So some example of this includes buying at the peak of a hype cycle or a meme coin or a meme stock, and then panicking selling during the crash. Throwing money at risky options trade, meme coins, or meme stock and expecting overnight generational wealth. Buffett's version of never lose money comes down to these basic principles. Alright, so on to rule number 2, and that is to never forget rule number 1. I'm just kidding, guys. Rule number 2, be greedy when others are fearful and fearful when others are greedy. This is another famous quote by the GOAT Warren Buffett himself. When everyone gets greedy, that's when markets becomes dangerous, and here are some examples. During the dot-com bubble, investors were throwing money at anything that has a .com in the name. Greed pushed markets to its insane levels before finally collapsing. Another example is the 2008 housing market crash. Confidence turned into pure greed. People believed home prices could never drop, and that overconfidence led to one of the biggest disasters in history. But when fear takes over, that's where opportunities come. And here are some examples. During the COVID-19 crash, the markets fell over 30% in just weeks. Panic everywhere, but those who invested during the peak fear saw massive gains in the recovery phase. Earlier in 2025, when Trump announced new tariffs and the markets instantly sold off in panic, fear spiked to its worst levels in years. The fear and greed index was basically near 20, but disciplined investors recognized it as a temporary shock and a chance to buy quality stocks at a discount. So in summary, greed inflates bubbles, fear creates opportunities. Alright, so coming in at rule number 3. Time in the market beats time in the market. Guys, nobody can predict the future perfectly. Nobody can predict short-term fluctuations or try to buy the exact asset at the exact lowest price and try to sell it at the exact highest point. It is nearly impossible. Even for professional investors, hedge funds, and institutional investors, it is extremely difficult. So us regular retail folks, we don't stand a chance. Compounding works best over time. Even small, consistent returns can grow exponentially when left invested for years. Short-term dips are relatively normal because the markets will always have its ups and downs, and selling during a dip locks in losses, while staying invested allows for your portfolio to recover. Focus on what you can control instead of timing the exact trades, and focus on contributions, asset allocation, risk management, and discipline. These are the things that you can actually control. Rule number 4, past performance does not guarantee future results. Guys, just because an investment performed well doesn't mean it will keep performing just as well. And this is where most beginners get trapped. I want you guys to think of it like this. If Steph Curry was to shoot 5 shots in a row and make 5, do you guys think he would make the next one? Most people will say yes. And that, ladies and gentlemen, is what's called the hot hand fallacy. The truth is, the chance of him making the next shot is no greater than the previous 5 shots. Short-term streaks don't guarantee long-term success. But over his career, Curry's greatness isn't about one single game. It's about years of consistency, skill, practice, and staying in the game. That is why he has the highest 3-point percentages ever. In investing, it works the same way. Trying to time the market based on short-term fluctuations, that's like betting on a single hot streak. Stay invested in long-term, letting compounding do its work. That's like Steph Curry's career, steady and consistent, improving to succeed over time. So the key takeaway is, don't chase short-term wins. Focus on staying in the market for the long term. That is how wealth is grown over time. And that's basically everything in life. Time in the market beats time in the market every single time. Alright, so coming in at rule number 5. Don't put all your eggs in one basket. Guys, even the best companies in the world can have its bad years, bad moments, unexpected scandals, or sudden drops in price. By spreading your investment across different sectors, asset classes, or even different regions of the world, you can protect yourself from short-term fluctuations. A good example is back when I first started investing, I was heavily into crypto. I basically had my entire capital and portfolio focused on crypto, and particularly Ethereum and Dogecoin. And when Dogecoin spiked to its all-time highs, I got a little bit greedy. I didn't take my profits, and as a result, my investment lost almost half its initial investment. So as always, had I just invested in something else, like even Bitcoin, the S&P, or any other large growth stocks like Tesla, Nvidia, or anything else, my loss could have been substantially reduced. But it is what it is, and I learned my lesson. Alright, so there you have it, folks. These are the rules that you must know as a beginner, and as long as you're following them, you're already ahead of 90% of investors out there. If you want to learn more about investing, I'm going to leave these 2 videos right here for you. But before you click on them, I want to ask you guys to do me a quick favor. And you already know what it is. Hold on, pause. This is Economics, and I'll see you guys next time.